Many people dream of a mortgage-free life, where they own their home outright and no longer have to make monthly payments. However, before rushing towards that goal, it's important to consider some reasons why paying off your mortgage early might not be as financially beneficial as you believe. Here are 6 insightful points that could alter your perspective. To get the complete picture, be sure to watch the entire video. Number 1. You might earn more somewhere else. Think of repaying your mortgage like getting back almost the same amount of money you borrowed at the interest rate of your loan. If your mortgage has a 4% interest rate and you pay it off early, you're basically earning around 4% on the money you saved for the remaining time you would have had the loan, which could be up to 30 years. Imagine you're getting more money than what you could earn with a safe investment for that same time. In this situation, it might be smarter to keep your mortgage and invest any extra money you have in things like the stock market. From 1992 to 2021, if you look at a really long time period, the stock market has grown by about 10.66% on average each year. This is higher than many mortgage interest rates. Even when you consider inflation, the stock market still did really well at around 8.10%. Keep in mind that the stock market can go up and down a lot, so your money might sometimes be more and sometimes less over a long time. Number 2. Start by creating an emergency fund. Before you decide to pay off your mortgage, make sure you have enough money saved up to handle unexpected situations like losing your job or facing a big medical bill. It might be tough to gather enough money quickly for emergencies, especially if it happens when the economy is not doing well, and getting new loans is harder. To make your financial situation stronger, start building an emergency fund. This fund should have enough money to cover your expenses for 3 to 6 months. Having this money ready can help you get through tough times without having to use credit cards or borrow money. You might want to keep your emergency money in a special savings account that gives you more interest compared to a regular savings account. This way, your money can grow a little more while you're keeping it safe. Number 3. Prioritize paying off high-interest debt initially. If you owe money on things like credit cards or personal loans, it might not be the best idea to pay off your mortgage early. Those debts usually have higher interest rates than your mortgage. When the interest rate is higher, your debt grows faster. It's a good plan to calculate and figure out which option is better for your money. Make a list of all the debts you have and their interest rates. Then compare those rates with your mortgage interest rate. Try to pay off the debts that have higher interest rates than your mortgage. This way, you can save more money in the long run. Number 4. You might gain from the tax deduction. If you're looking to pay less in taxes, it might be better not to pay off your mortgage early. The government lets you subtract the mortgage interest you pay from your income before calculating taxes. This helps lower the amount of tax you owe. You can use this deduction for the entire time you have the loan. Also, if you completely pay off your mortgage, you could cancel out the progress you made in reducing your taxes using other methods. For example, if you're putting money into a retirement account or investing in certain types of bonds that help with taxes. But keep in mind, after the big increase in the standard deduction in 2018, you might only get the mortgage interest deduction if you choose to itemize your tax return. Number 5. You can have more available cash. Using extra money to pay off your home sooner might not be the best idea, as it could use up your accessible cash. When you put that money into your house, it's not easy to get it back quickly. If you ever need money urgently, selling your home and getting the money could be slow. It's important to have enough cash that you can easily turn into money without any extra costs. These are things like your emergency savings, stocks, bonds, or special retirement accounts that help with taxes. Having these kinds of assets gives you more choices when you urgently need money. On the other hand, if all your money is in your house, you might have to borrow or use a credit card and then pay back the money with added interest. Number 6. Consider investing more in your retirement savings. If you're not putting as much money as you can into your retirement savings, or if you're trying to catch up on your retirement savings, it might be better to use your extra money for that. Usually, retirement accounts like your 401k or IRA grow without taxes until you take the money out. Using your extra money to pay off your mortgage might mean you're missing out on a good chance, especially if your employer adds money to your retirement account too. That extra money from your employer can grow over time, and it helps make sure you have enough saved up for when you retire. In the end, Whether you decide to pay off your house early is up to you. It's a personal choice that should match your goals, how much risk you're comfortable with, and what you believe in. Paying off your mortgage early might give you a sense of security. If you ever have a tough time like losing your job, you'll know you and your family will still have a home. Having a good credit score also helps you have more financial options. You can get low-interest car loans, credit cards with travel rewards, and other things. Before you apply for new credit, make sure to look at your credit report and score for free with Experian. This will show you where you stand. If you see any mistakes or fake information on your credit report, you can tell the credit bureau and they'll take it off. Thanks for watching. Don't forget to like, share, and subscribe so you don't miss an upload and you can enjoy the excellent content I send your way.